Thank you. This is indeed a panel of heavy hitters. I think we've been privileged to have a formidable lineup here. None of them need any introduction. I'm going to just dive in straight. I think that so the topic that we have is macro, multiples, and markets. It's MMNM. And the panel was also chosen to talk about it, at least from an India perspective. We have M for Manish, M for Mukesh, Simran, Menezes, and Kunal. Since you are the standout there as an LP. So so I thought I'd break up the session into 2 or 3 parts, talking about all 3 aspects. Maybe I start off with macro. Kunal, if I may jump to you. In a world that is now increasingly fragmented, and the word that I think will be uttered the most number of times at this conference is the word geopolitically. Right? So the geopolitical risk and the economical risk, where do you see India sort of emerge? Like, how do you see it do you see it as a beneficiary of capital that is looking for more stability? Or do you just see global volatility sort of compress the overall risk appetite across private markets?
So, hi. Can you hear me? So let me start by painting a bit of a global picture in some respects, and India is obviously a part of that. West Asia, which is obviously top of mind for everybody, there's a multi-dimensional challenge there. A lot of it is short-term challenges on oil price volatility, as well as supply chain impacts. But there's also perhaps longer-term implications of what's happening there. Now, when you overlay that with what else has happened in the world, the Ukraine conflict, the West Asia conflict ongoing. In India's own neighborhood, there's conflict ongoing with Afghanistan and Pakistan as well. In all of these, private market investors can say, well, I'm not really investing or don't have a huge exposure to oil and gas directly. I'm not an investor there, not an investor in West Asia to that extent. And so there is an out available. But I think what is really being not part of the discourse, perhaps, in India more recently, but certainly grabbed a lot of headlines and attention in private markets globally, is what happened in software and SaaS in the last 30 to 40 days. So Anthropic came out with their own agentic solutions and really got into workflow, and that triggered a sharp correction in SaaS and software. Now, the way many investors view this is sort of an important moment in time, because what you're seeing is over the last few years, billions of dollars got invested into software. Software has been part of portfolios for a lot of private market investors. And when you see such sharp corrections, you're really questioning how this will play out in the future. So when you say billions of dollars invested, a lot of it came in 2020, 21 at peak valuations. A lot of these companies are sort of have high valuation and high leverage as well. And so what you're going to expect to see is really for them to be in a race against time to find a solution to use AI into their business and compete with AI native companies. Now, something like this has had a ripple effect into private credit. You've seen some stress on the semi-liquids in the US. A lot of this has more significant immediate effects on private market portfolios. And so what is unusual at this point in time is if you put it all together from all the geopolitics we talked about, all the various conflicts going on, and what's happened in software, what's happened in private credit, it's really unusual to see all of these risks come together for private markets at the same time. And I think that's where the challenge lies, and India is certainly going to have to navigate that challenge as well.
No, certainly. I think the compounding of risks, and all of them occurring at the same time, the coincidence is something that's really worrisome. So maybe Simran, maybe on that, how do you see the impact of the risk premium on private markets? Do you see, and how do all of us as long-term investors, what's your advice in terms of how we should behave or what we should do differently?
Absolutely. So I think the one thing that shifted in terms of the impact of geopolitical risk is that it used to be something which is more occasional or sporadic. It's really pivoted to one which is more consistent, and we have to build that in as we think about underwriting as long-term investors. This manifests in different ways. It can impact businesses which have a high dependency on global supply chains, both on the input as well as the customer end. It can have a transmission effect on the real economy in terms of higher cost structures, decreasing consumer confidence, all of which impacts earnings in the near to medium term. And of course, what we've seen, which is volatility, both in terms of currency as well as capital markets. Having said that, India is still a very exciting place to invest in. You know, we are benefiting from certain fundamental growth drivers, our demographics, rising income levels, deepening capital markets. So therefore, the question really pivots to how do we invest and build businesses that compound during periods of this risk, and how do we really identify that? There are three ways that we can do that. The first is invest and build businesses which are fundamental to India's growth. They're businesses in the consumer, healthcare services, financial services sectors, which are set up not to compound for the next 5 years, but possibly the next 10, 20 years to come, which is why we've invested in healthcare services, education, to really benefit from that thematic. The second is in terms of when there is such volatility, it's important to have very strong capital structures and low leverage. Management teams need to focus on what is the growth and execution of a business versus worrying around liquidity risk or refinancing risk. And therefore, it's very important to have a strong and resilient capital structure. And the third is just prepare businesses for exit optionality. You can't be reliant on a single window or a single avenue as you think about exit. Therefore, bringing it all together, it's critical to invest in businesses which can compound in periods of this uncertainty in India.
Thank you, Simran. So, Manish, I'm going to jump to you on a similar point, right? Clearly, India's growth story or the investments into India have been largely driven by what's happening in the domestic market, right? But again, just going back to the macro in this global environment, is this a real insulation mechanism that we have, or are we just like ostriches with our heads buried in the sand and sort of overstating this resilience?
The mic being off is Ashley's way of giving a message to all of us to not speak too much. First, thanks for having us here. This is a great time to have this discussion, very timely. I like the analogy with the ostriches, and I think that's the question we have to keep asking ourselves seriously. Not just now, because actually now I think the world is real. And in a strange way, I'm actually more excited as a PE investor in India today than I was 3 months ago when things were relatively nicer around the world, but only as an investor, not the humane part of life. I first want to just take off, because it's connected to the answer. Kunal gave us a good overlay. The one additional area in alternatives more broadly, not just private equity, is private credit. When you combine what Kunal said about software and look at portfolios, I don't think none of us are exposed to the level of Thoma Brava or Insight or one of those guys are, where 80% or 90% of the portfolio is software services. And then add to that what Simran mentioned, which is a huge amount of leverage, which today is coming from private credit, whether it's an Ares or Apollo or my friends at Blue Owl. They're the ones giving the credit. So I don't know if you all picked this up, but about 2 weeks ago, both Blue Owl and BlackRock put gates on their funds. This is gates on funds where the source of money is large retail customers, not large institutional investors. If this, for all of us who are still around and have memories of 07, 08, we're partly showing our age, but the gates the hedge funds put on was the start of the crisis. So many people are calling today the 2008 for private credit. If that was to happen, all bets are off. Now, I'm contrasting this to say why we are not ostriches in the sand. And we actually in India, and I'm going to take off from what Simran said, are in a unique position, right? Because let's just take the biggest thing affecting us the last 12 months were global tariffs. Which of our portfolios were impacted? I would say it's almost zero if you look at the four of us as GPs, because most of our exposure is financial services or consumer. 99% of the consumers we serve are local. So I feel bad for BK Goenka and crew at Wellspun or a few other gem and gemology people who suffered badly, but for 95% of India, it didn't affect us. And I really think in India, it doesn't matter what the global economy is doing. Of course, it's important, you need to be aware. But the biggest thing as GPs, I would say, is knowing what you are not good at and keeping away from that crap. For us, it's real estate, infrastructure, anything which needs government regulatory approval. We don't want to be in the firing line where the value chain has an Ambani and Adani. Not that we're fearful, just because they can influence policy better than we can. So we'd be at a competitive disadvantage. And focus on the areas where we know something about, in our case, financial services, consumer, healthcare, and maybe a bit of tech services, and then get the best playbook, which we can talk about later, whether it's senior operating partners or whatever it might be. So I actually think, given the mess in the world right now, which you obviously feel bad as a human being, as an investor, what we had done for the last 1 year is put the brakes on new deployment and really accelerated our exits. And at this, I'm not saying we were just lucky. We sold a large chunk of our holding in Vishal Megama 3 weeks ago, right before, I want to say we predicted the war, but obviously we did. We were lucky. We got 500 million out in the markets, back to our investors and LPs at a time, and then the markets have frozen, and that price has gone down by 25%. But as an investor now, where all of us have dry powder, the next 6 to 12 months, I think would be very, very opportunistic, looking at the silver lining in a very gray crowd on what we could be deploying capital in. So I'll stop there for now.
Thank you, Manish. I think it's a very important point, as GPs. One is to know what you do, but as Manish pointed, it's also important to know what you shouldn't do and what you avoid. I think so that's something that is extremely critical. Global markets have sort of seen a correction. Mukesh, if I can bring you in. Indian companies' performances, if you look at it over the last 12, 18 months, still performance has not been very stellar. It's sort of been subdued, right? Indian company valuations or deals as we invest have not come off. So do you see that change? Are we at the peak there? One mantra is as Manish said, to sort of put the brakes on a little bit on investing. Do you think that's the right strategy? Is there something else that you think we should be thinking about?
No, frankly, if you look at it, whenever you come to India, for the last 20 years I've been doing this, you always feel Indian market is expensive. And that has been the case 20 years back, that has been the case 10 years back, that's been the case 5 years back, that's been the case today as well. It will always trade at premium to global markets. And if you would have invested in India 20 years back, that would have given one of the best returns globally across all markets, 10% USD returns. So this premium valuations will continue in Indian market. And that's a pure function of high return on equity and growth. When you have both together, it will trade at premium. Now, coming to, there are cycles. Last year was quite a heated market. Nifty was trading at 25 times price earning. Today it's trading at 20 times price earning. And I believe public markets have corrected. And like all cycles we have seen in private equity, there's a laggard effect between private market and public market. But at some point of time, private market will start reflecting public market multiples. And as Manish rightly pointed out, we are very bullish. I think this is coming to a market where it will be great for investors who have a lot of dry powder. And last year, you would have seen there were a lot of exits. PE firms took their benefit of the market multiples and exited a lot. And frankly, Kunal and Manish also spoke about the credit crisis. But frankly, Indian private equity market is immune to it. And the only reason for that is, as you know, in India, leverage is not allowed to, in India, LBOs are not allowed, pure LBOs, operating LBOs, because you cannot finance to buyout companies. You have to take leverage at holdco levels. And that's why those leverage levels, especially for the buyout firms, is not more than 4 to 5 times EBITDA. So where you've seen where the financing market really melts down, globally, the developed market like US and UK, which are primarily secondary buyouts and primarily levered buyouts, they see a lot of slowdown in the market. But from our point of view, most of our returns are through building businesses to growth. So I believe from that point of view, credit will not have that much effect on the Indian market. Obviously, operating performance will matter more, and with the negotiation of tariffs, I think India is in a good position now. And it's a great time to enter India.
Thank you, Mukesh. So I'm going to change gears a little bit. I'm going to take that cue and segue more into multiples and underwriting discipline. Just taking on from Mukesh's point, Simran, the last decade arguably has benefited from multiple expansion. Do you see the next decade now, as valuations are where they are, force us to drive operational alpha? And if so, what do you think are the levers that we can use? Mukesh talked about, leverage not really being available in the Indian context. I mean, there are structures to do that, but what are you seeing, people do, or how are you thinking of sort of this as we move over the next decade?
No, absolutely. I think for us, our returns have to be driven by what we can control, which is fundamentally the operating performance as a business, as well as the cash flow conversion. As you make good quality businesses great, the multiple expansion, if markets are kind, will come. And therefore, you have to focus on what you can control. This is actually an approach that we have taken over the last few years as well, and what it's entailed is a few different things. The first is building a high-quality management team upfront at the time of investment. What we've seen is that the differentiator between a high-quality business and an average business is really execution, and that's strongly correlated to the strength of the management team. We spend a lot of time upfront identifying the depth of the talent, also identifying the gaps, and very often investing behind it sooner so that we're ready to be able to drive the growth that we actually see. The second is really around value creation initiatives. Our diligence has actually pivoted to being more focused on what are the 3 to 5 things under our ownership we can drive and change and implement. Typically, this is also done with folks who have operated in a certain sector or industry. This can vary across companies. It can be related to sales force acceleration. It can be related to procurement-related efficiencies. It can be related to tech enablement. But it's very critical for us to know exactly what we will execute on from the time that we close. The third, I'd say, is M&A. In India, we're also in a unique position where some sectors and subsectors are still relatively fragmented. And therefore, using M&A as a lever to be able to scale and drive consolidation is an important tool. M&A can drive you to enter new markets, strengthen your position in existing markets, get differentiated capabilities, and therefore that becomes an important tool to also be able to scale and expand. I think in all of this, the other critical part for all of us as owners is to make sure that we're able to have proper governance and review mechanisms to track performance consistently, so we're able to course correct early on if needed. I think all of this is really what ends up driving the operational alpha, so to say, and which, as you see the quality of a business becoming better, you benefit from the multiple expansion when markets are actually beneficial.
Thank you, Simran. I think that's a good perspective from in a buyout kind of situation. Manish, if I can draw you in for a second, I know you guys do both buyouts as well as minority. How would what are the levers you can employ or deploy in a minority kind of situation? Because you don't have the flexibility to do everything that Simran said. You can't do all of that in minority situations. So how do you deal with that?
No, listen, I think the way I'll answer that, Ashley, is the following. Firstly, the opportunity set in India is where it is for a couple of reasons, right? One, look at TAM, total market sizes, and where we are. We're sort of the tip of the iceberg. We had a controlling stake in a housing finance company, a mortgage company, right? And we had to sell it because our fund life was getting over. That's a company I'd want to stay on forever if I had permanent capital. So we take the learnings from that and say, how many other places can we deploy that learning? Maybe in other less evolved mortgage companies. Second is quality of entrepreneur, which is exceptional in India, and driven by those two, a very high growth rate. So valuations, while they're high, and I've said put the brakes on. When I say put the brakes, it doesn't mean zero, it just means raising the bar. To the earlier question, I don't think we can assume multiple expansions anymore. If you look at every IC we go to, if any team tries to make their IRR or MOIC numbers by tweaking the multiple number, in fact, we in certain sectors, such as consumer today, would be a lot more conservative and say in the IC case, we want to see at least a couple of downside cases with a slight and then a significant multiple compression. So that's critical. What does that leave us to is what do you do? Now, this is where I think we differ a lot from other. We would only take on companies simplistically which have two qualifications. One, it's not broken. We're not turnaround guys. And I don't think in India you have the time frame in a fund structure to do a dramatic turnaround on the P&L. If it's a broken balance sheet and needs an adjustment of capital, we may even do that. But otherwise, you want a situation where you make a good company better. It's not turning around a broken company, which I think is a very important thing to get, though it sounds quite simple. And then within that, the toolkit. And here, Ashley, actually, this is where I would say we differ. What we do in a minority versus a control. Yes, optically, it might look very different, but actually, the levers are not even similar, they're identical. And I actually had our team, you naturally assume if you had a 2x2, a graph which had equity ownership on the x-axis and the y-axis you had either time spent on the deal or returns, you would assume as you have more equity, as a management we'd have more time, and you imply at the back of your head is better returns. And again, I'm not saying this to make ourselves look good or bad. If you look at the chart where we plotted 30 of our portfolio companies, it was a scatter diagram. I can take any 2 points. If Kunal's then, I want to give him a certain message, I'd use 2 data points to say, we do A or B. But frankly, the tools are identical because where are you adding that? Everyone does strategy and all that. But the biggest value add is people in my mind. These are tier 2, tier 3 companies. They can't attract who a Mahindra or a Bajaj or a Tata can approach. Having us there, and more importantly for us, our operating partners, we have people like Nitin Paranjpay, who's the chairman of doing our consumer company, someone like a Keki Mistry helping us on our financial services. So it doesn't matter if it's a control or a minority, addition of people for these sort of companies is critical, and that's what we do. And then obviously the other one, I think which Ashley is, we out of our 30 investments in our 12-year life, 14-year life, we've taken 9 companies to IPO, preparing the companies, what to be done, what's not to be done. Of course, you also do the M&A and everything else, but all I'm saying is our playbook is unique, but whether we apply it to a growth situation or a buyout situation, it doesn't change a whole lot.
Thank you, Manish. Mukesh, similar question. Given what's happened in the evolution of the private equity space, you talked about, valuations being where they are, right? And that's sort of more of a norm now. How has that influenced or sort of changed the way your underwriting standards or the way you look at, doing deals?
See, frankly, our underwriting standards have remained same for the last 10 years. Why fix what's not broken and what's working well? If you look at it, I think the way we look at businesses is we have a business builder approach. Gone are the days where you buy low, sell high. There are enough private equity firms, enough smart investors who can do that. So the only way, as Simran pointed out, to make returns in this competitive market is to build businesses. And let me give you examples. By the way, India is the best performing geography for Blackstone globally. And if you look at, let me talk about deals which have been done 10 years back, whether it be Taskers or Aadhaar, which was almost on brink of bankruptcy. Both these companies' profits grew by almost 6 times in a period of 5 years. And let's fast forward the last 2 deals which we have done, which is Care Hospitals, IGI, VFS. Again, Care was not even the top 10 hospitals in India. In 2 years, with, as Simran pointed out, with M&A, it became the top 2nd largest hospital chain in India. Sona Comstar, again, not the top 20 auto component company of India, became top 5 auto component company of India. The point I want to mention is the returns, you're not looking at public market returns. The people, the LPs are giving you money to drive alpha, and that alpha will only come if you improve the company from where you bought to where it is now. And that will come with management, with inorganic acquisitions and defined strategy. So frankly, from our point of view, we continue the control mindset. And I think, as Manish rightly pointed out, it's not about how much stake you own, but it's how much value you add, whether you're a 30% shareholder or a 70% shareholder. So for us, I believe the strategy remains same, which is have a business builder mindset.
Thanks, Mukesh. I'm going to shift gears to markets, talk about both fundraising as well as exits. And Kunal, if I can rope you in first, right? I mean, you've been an investor for decades, right? What differentiates, and I'm not talking only India, but what differentiates a GP who's able and successful in raising capital versus the many others that are struggling? Right? What are the nuances you look for in some of those GPs?
Yeah, that's an interesting question. I think part of that answer is obvious. People will say stable teams and track records and all of the things that this room is very well versed with. So I won't go into some of these obvious things. I think I'll come back to what I said earlier. You're sitting at a point in time right now where it's unusual to see all of the risks that we talked about come together at the same time. I can't remember when all of it was happening other than during a big financial crisis of 2008. And so I think that's where the judgment will be quite important, and that will reflect maybe over time, but that judgment to, the panelists were talking about playing to your strengths, making sure you're trying to create capabilities within your team to cater to the environment that you're in now, rather than what you're used to seeing in the past, and because that certain playbook has worked well for you. And in that context, you are seeing a rise of more specialization happening within teams. It's the era where rising tide lifted all boats is probably more difficult to see going forward. I think you will have to earn your returns. In many ways, you will have to supplement your investment team with a lot of operating capabilities if you didn't have that already, and maybe go a step further and saying, how do I get my portfolio ready for the risks now of things like AI? We talked about software. And I do think in some of these things, there will be sort of winners and losers. So in my personal opinion, this will be a K-shaped recovery where some companies are able to keep up, make those changes, re-establish their competitive mode, and some companies would not be able to do that because there will be a new incumbent, an AI native company that comes in and really disrupts the traditional business model. I think some of those risks are probably underrated in the Indian context, I'd say. There are not as many listed SaaS companies in India, and so that doesn't get a lot of media attention. But that is certainly still a part of the private markets portfolio here, both on the VC side as well as private equity side. And I think these are some of the things that managers will need to navigate going forward. So to your long-winded answer to your direct question on what will matter is your judgment and ability to navigate environments like this will really set apart your track record, which will make it easier for you to fundraise. And lastly, I'll come to, just from an LP lens, what will be important for a lot of LPs globally will your own ability to diversify across strategies, markets, your own ability to do manager selection, frankly, in many ways, and deal selection. So including the rising emergence of things like secondaries as a liquidity solution, because the product like secondaries actually thrives in markets, environments of dislocation, because they come in and are able to price the risk today versus what the manager may have underwritten at the time of their entry. And I think so. A lot said there in terms of what might work or not, and I think only time will tell. But these are some of the things I'd say to watch out for.
Thanks, Kunal. I want to come back to secondaries in a little bit, but Manish, if I can draw you in. For an India-focused manager, how has that conversation with LPs evolved over the last many years, right? Are you seeing a different sort of demand, whether it is things like processes, governance, ESG, versus just pure returns? How do you the conversations around currency, geopolitical risks, etc. How's that evolved?
Let me try to tick off a whole bunch of these quick points quickly, but I'll just start with the context. Um, I agree with Kunal completely that the market is going to be bifurcated. And I see that as our own example. When we started off Kedara about 15 years ago, it took us more than 2.5 years to raise our first fund, which was about 500 million or thereabouts, maybe a little bit more. And compare that to Fund 4, which we raised a year and a half ago. Despite being quite a bad market for fundraising, we closed that in 3.5 to 4 months, and we were significantly oversubscribed. And we shut off capital and closed it at 1.8 billion. So with that framework in mind, what was important? Obviously, as Kunal will tell you, he won't look at the next fund unless there's performance. That goes without saying. I think the 2 or 3 things which I think are equally important and people misread is actually performance only comes by team, but it's not just, you don't want to put 3 big names out there and say it's done. It's the consistency of the team, how long have they been together, the quality of the team, and the level of institutionalization. I think we're really proud that we didn't know this when we started, we evolved over time. We rapidly institutionalized. We started with 3 partners, we have 5 partners. We gave carry to everyone, the youngest member of the investment team. Now we make sure it goes down to the full admin team. Very, very few points of carry, but they all behave like owners. And what people don't get is LPs are smart enough to see this, and the level of because this is, if you were a hedge fund and you could get your gates and take money out tomorrow, people are investing in a product which is illiquid for 10 years. It'd be really, now I know I'm shooting myself, it'd be really stupid to do that when someone is getting to an age where he or she should be retiring and you have no clue who's going to be the successor. That's one extreme. But LPs are smart enough to understand that and then the dynamics. The ability for the youngsters, the culture of the firm. And I think the smarter LPs, frankly, do their due diligence, not those 3 months or 4 months for fundraising. They're visiting you throughout the year. They know what you're doing and how do you behave with the coffee boy. To me, is more important in your office than the gyan or the pontification you do on your AGM, right? Seriously. To me, that's... so I think performance obviously is necessary, but I think it has to be put in the context of institutionalization. And I know Rajat and Akriti will shoot me. Stuff like, ESG was the single most important thing 3 or 4 years ago. I have Kunal, I can't say otherwise. It was important, but then you need to break it up. The E to us, the governance is what, in my mind, the most critical. Suddenly Trump has come, and suddenly global macro has made the E less relevant. How can that be, right? So we had a certain perspective of this which hasn't changed over 5 or 6 years. There will always be a new toy that people will proclaim. Every organization, the LPCA, whatever will put, this is what you need to do. I think at the gut, you can, as far as you don't lie to yourselves and to your fund you represent, to the LPs whose money you manage, don't get taken in by fads is the only other thing that I'd say, which sounds kind of crazy in this overall. So, shortly, performance, team, institutionalization, everything else in my mind, whether it's ESG or other, you need to believe what you need in there to learn from, but the rest to me are fads.
Thank you, Manish. Very, very insightful. I'm going to switch gears in the interest of time to sort of exit. Simran, I'm going to ask you to comment on, capital markets, we're seeing what's happening now, and has always been very cyclical. How important is to sort of build in that optionality for an exit at the time of investment itself, right? And how successful have you been in sort of being able to achieve that?
It's a very relevant and fair point. I think when we build businesses, you have to make sure that you're not reliant on a single avenue to exit or a timing window. But I think the fundamental point is that when you actually invest and build good quality businesses, you inherently increase the exit optionality. That's the crux of it. And this is done by a few different ways. The first is making sure that you're building an organization or an institution which really outlives one single shareholder. That means having a very strong governance construct, which is what Manish was talking about. It means that you have to ensure that these are businesses which have strong management teams. Because if you look at analogs in the US, etc., you don't really look at one shareholder. You look at a business which is governed by a board, and that's what we all have to aspire to do. The second is be very deliberate in terms of how you think about growth for a business, both organically as well as inorganically. You know, businesses which have strong market positioning, clear differentiated capabilities, always end up being more attractive as you think about just creating that exit optionality, and therefore it's very important to think through where are you putting that incremental capital to be able to drive growth. The third, I'd say, especially in sectors which have the ability to compound over a long period of time, it always makes sense to keep reinvesting in the business, that even an incoming shareholder, when you think about an exit, is seeing that runway for growth. That becomes extremely critical as well as you create exit optionality. And the last, which is actually the most important, which is when you have other stakeholders also on the capital table apart from you, it's important to have the tough conversations at the time of entry versus at the time of exit, particularly in times of, you know, what's the liquidity time frame, how would you think about who's carrying on the management, how do you think about the governance. It's more important to have those tougher conversations sooner, that when the opportunity actually arises, you're able to take the benefit of it versus having these conversations at that point. And this is something that we follow across our portfolio as we think about building these businesses.
Mukesh, coming to you, I think even in the last panel, there was a conversation about how exits in India have been scarce, right? And the one thing that Neha mentioned, the chakra view where everybody is able to get in and make the investment, but getting out is the issue. But that has evolved, and Blackstone specifically has been fairly successful in the recent times. So what's your view on the current exit environment and with capital markets and others? How do you see that sort of evolve?
I think to the earlier question, what you asked, what LPs look for is not just IRR. I think there are only two metrics which matter to LPs. First is IRR, and more important is actually DPI, which is the distributions. And that goes to your point, when you're going to market, when you have high successful distribution, those are the funds who are getting the money. Specifically on exits, frankly, we had a checkup past the first 4-5 years where we were not as successful in the minority setup. But we changed our strategy somewhere in 2012 to control. And the biggest learning for us from change to control strategy was the control on exit. We are no longer dependent on a CEO or a founder to determine where we want to exit. For example, IGI, we actually exited in a matter of 12 months by taking company public. Or there are investments which we have held on for 5 years, where we see compounding of growth, and we have exited after 5 years. So control gives you exit optionality, whether it's dividend recap, whether it's sale to a minority shareholder, sale to a sovereign fund, or exit to an IPO market. So that's first point. From our point of view, it has been last 2 years have been great from an exit point of view. We have exited almost $5 billion in Indian market, and equally we have invested $5 billion in India in the last 2 years as well. So I think the most important point is exit optionality by controlling the exit, whether being even if you're a minority shareholder, having those rights, and being a controlling stakeholder, anyways, you have the option to exit anytime you want. And as Simran rightly pointed out, even if you have a controlling stake, but the company is not operating well, you'll not be able to exit. So performance comes first in terms of operating performance of the company, and then the second point which I'm talking about.
Thank you, Mukesh. Clearly, you want to build in that optionality at the time of making the investment. You want to look at all options. You want to be able to control the way you exit. But timing may not necessarily play out. So Kunal, I'm going to pull you in on this. We're seeing in the recent past, in the recent couple of years, a lot more secondaries, continuation funds. Is that now something that you see evolving as part of the more of a structural exit toolkit for Indian GPs? I know you guys have been very active on that. So what's your perspective and what's your advice to GPs on that?
Yeah, I'll start by painting a global picture because I think India is still early on that journey, and my personal hope is that it'll get there. But if you really look at the GP-led secondaries market, which is single asset continuation vehicles or multi-asset continuation vehicle, from 2020 to 2025, that market has grown from 30 billion to about 110 billion in 2025. So nearly a 4x growth in 5 years. So this is the fastest growing part of private markets globally. And so it's come to a stage that it's now well established as the fourth exit route. So over the last few years, the routes to exit were trade sales, sale to a sponsor, or you IPO. I think if you see the data over the last few years globally, about 12% of all sponsor-backed exits consistently over the last few years have been through GP-led secondaries. So this is now established as the fourth pillar of exits globally. And I think there are a couple of reasons why, and 3 reasons that will come to mind on why I think this is sort of a sustainable trend. In many ways, there's a positive selection bias because the GPs are motivated to put their best assets into these CVs. So that's really helpful when you come in as a secondary buyer for these assets. These deals are typically lower risk compared to blind pool investing because these are companies that the sponsor knows for a long time, has been shareholders of. And lastly, this is probably the part of the private markets ecosystem where there's the highest level of alignment with your incoming secondary buyers. So in terms of GP commits or the next fund also putting commitment into the CV, I think you see probably the highest level of commitment across private markets through these CVs. So I think in many ways this is now well established as the fourth exit route globally. And my hope is that we'll see some increase in volume in the Indian context as well when it comes to exit on these side of things.
Thank you, Kunal. We're almost out of time, so I'm going to put my panelists on the spot with a rapid fire. 1 minute to each of you, maybe starting with you, Simran. One structural tailwind for Indian private equity and one sort of risk that we shouldn't underestimate, in your opinion.
Sure. The tailwind, I would say, is just the broad-based consumption growth in India, particularly coming from tier 2 and below cities. I think that's going to give us the ability to create many more larger scale businesses in the country. And I think the risk is just the impact that AI will have on repurposing our workforce and also in light of having to create 20 million jobs annually.
Mukesh?
I think tailwind is still we are a primary market and still we are growing. We are not matured as compared to US and UK. So a lot of opportunities still available, whether being carved out from MNCs or corporates or the succession issues where we are buying for founders. So see a lot of growth in the India buyout market. In terms of a risk, India is known for self-goals. So predictability in terms of regulatory framework and certain policies, that would be the risk.
Manish?
I would say the tailwind is just the growing size and recognition of domestic capital, whether it's as LPs into our different functions or more importantly as exits in the IPO market, which is being fueled by domestic capital. The tailwind in my mind, I agree with what both Mukesh and Simran said, but the one I'd point out is internal arrogance in our industry, and that doesn't go out of, even as the industry evolves, we as players don't get arrogant, and there's some degree of humility which stays.
Well, I think there are a lot of tailwinds, but in the interest of time, I'll say the excitement and depth of entrepreneurial talent, frankly, to my mind, I think that's where the ultimate excitement comes from. And in terms of risks, well, as the world moves away from knowledge economy into tokens, I think India has a lot of navigation to do. We have a large workforce. We need to create the jobs, but yet the world is moving in a direction which leads to more efficiency and probably fewer jobs over the longer term. So being able to effectively navigate that across sectors and across parts of the country, I think will be a key to risk to monitor.
Thank you, Kunal. Rajat, do we have time for one or two? No? Okay, the panelists are around. I think this has been certainly a very insightful session. Thank you, all of you, for contributing to it. I certainly have learned a lot, and I'm sure our audience has been as well. So unfortunately, Rajat's not letting us do Q&A, but we are around, so please grab any of the panelists. Thank you again, Kunal, Manish, Mukesh, Simran.